Private credit is on the brink of a hidden crisis that could reshape the entire financial landscape. And the first risk is something almost nobody predicts. Stay tuned until we reveal the final shock that could echo through global markets. Surprisingly, the first tremor in private credit markets isn't a headline crash, but a quiet tightening of cash flows as lenders feel the strain of shrinking reserves. Banks that once funded loan pools with abundant short-term funding now face higher borrowing costs, forcing them to scrutinize every new commitment. This subtle shift reduces the pool of capital available to mid-market borrowers, who rely on private credit as a bridge. The ripple effect is immediate. Loan pipelines slow, and early-stage deals are put on hold, setting the stage for deeper vulnerabilities that will surface in the coming months.
Imagine a borrower who once seemed rock-solid now slipping just enough to raise eyebrows, prompting lenders to reassess credit scores that were previously taken for granted. As cash becomes scarcer, companies start to defer payments, stretch covenants, and tap alternative financing, subtly eroding their credit profiles. Lenders, wary of a tightening environment, begin to demand higher spreads, but many borrowers cannot meet the new terms, leading to a gradual downgrade of loan grades across the private credit universe. This erosion isn't dramatic, yet it builds a foundation of risk that compounds with every subsequent stressor.
In 2026, default statistics that were once single-digit are edging upward, signaling stress that could soon become systemic if left unchecked. Economic data shows a modest increase in delinquency among leveraged firms, particularly those in cyclical sectors like manufacturing and real estate. While the rise is still within historical variance, the speed of change is notable. Defaults that previously took years to accumulate are now appearing within months. Analysts attribute this to tighter credit conditions, higher interest expenses, and reduced operating cash flows, all converging to test the resilience of borrowers who once thrived on abundant liquidity.
Few people know that valuation models built on stable spreads now wobble like a candle in wind, making it harder for investors to price private credit assets accurately. Traditional discounted cash flow methods rely on predictable discount rates, but as market premiums fluctuate, the assumptions become volatile. This uncertainty forces fund managers to widen valuation bands, leading to larger write-down potentials and heightened scrutiny from auditors. Consequently, secondary market participants hesitate to trade, further dampening price discovery and amplifying the perception of risk throughout the ecosystem.
Hidden in the fine print of new loan agreements is a subtle relaxation of covenants that once protected lenders, a trend that has accelerated as borrowers demand more flexibility. Lenders, eager to keep capital flowing, have started to waive certain financial tests, extend reporting windows, and allow higher leverage ratios. While this eases immediate pressure on borrowers, it also reduces early warning signals that could prompt corrective action. Over time, the cumulative effect is a portfolio with weaker safeguards, making it more vulnerable to sudden shocks when market conditions tighten further.
Deep beneath the surface, the secondary market for private credit has begun to freeze, leaving investors with few exit options and creating a liquidity bottleneck. Historically, limited partners could sell stakes to other funds or secondary buyers, but recent volatility has made buyers wary, driving prices down and transactions to a crawl. This freeze not only traps capital but also forces managers to hold illiquid assets longer than planned, potentially impacting fund performance and prompting redemptions that strain the primary market even more.
Suddenly, regulators worldwide are reconsidering capital requirements, sending ripples through the private credit ecosystem that could tighten lending standards further. Some jurisdictions are proposing higher risk weightings for non-bank loan portfolios, while others are tightening disclosure rules for private placements. These policy shifts, though aimed at systemic stability, may unintentionally shrink the pool of capital available to mid-sized companies, reinforcing the liquidity squeeze and prompting lenders to become even more selective in their underwriting.
Meanwhile, the mood among institutional investors is changing, with risk-averse allocations creeping into portfolios once dominated by high-yield loans. Allocation committees are scrutinizing risk-adjusted returns more closely, favoring assets with clearer exit pathways and lower covenant risk. This sentiment shift translates into reduced capital commitments for new private credit funds, pressuring existing managers to compete for dwindling dollars, often at the expense of tighter underwriting standards and lower spreads.
As the market shifts, funding costs for borrowers climb sharply, eroding the thin margins that private credit thrives on. Central banks have kept policy rates elevated to combat inflation, and the resulting higher borrowing costs cascade down to the private credit space through increased loan-to-deposit spreads. Borrowers now face larger interest expenses, squeezing cash flow and making debt service more precarious. Lenders, in turn, must decide whether to absorb the higher cost or pass it on, a choice that can further strain borrower-lender relationships.
Finally, the convergence of all these pressures could trigger a systemic shock that reverberates beyond niche markets, catching even seasoned investors off guard. A sudden default cascade, amplified by frozen secondary markets and heightened regulatory constraints, may force a broad repricing of risk across the entire credit landscape. Such a shock would not only affect private credit funds but also spill over into public bond markets, equity valuations, and bank balance sheets, highlighting why understanding each preceding risk is crucial for navigating the uncertain terrain ahead.
We've journeyed from the first whisper of a liquidity squeeze all the way to a potential systemic shock, uncovering how each layer of risk compounds in today's tight money environment. Understanding these dynamics equips you to anticipate shifts before they become headlines. If you found this deep dive valuable, hit the like button and subscribe so you don't miss the next mind-blowing list we release each week. Which risk do you think will be the catalyst for the biggest market change? Let me know in the comments below.